Reading between the lines, the stock market has a message for us. And the next trend, well, it may come as a surprise. We have a lot to talk about today: declining inflation, the Fed's coming, and good news, maybe for stocks. We have declining inflation. The consumer price index was reported today at 2.8%. That's a decline. That's the first decline we've seen in quite a while now. And that really puts us back at levels we've seen actually below December readings. But more than that, it's a step in the right direction, and that's encouraging. Core CPI year over year, that's at 3.1%. That's the lowest low in a very long time, actually. Core CPI excludes food and energy. So it really shows us that all those other components of inflation are coming down. Well, not all components. Where is the inflation the best and the worst? And there is a divergence. These are the different sectors reported within the CPI number. The biggest gain, no surprise to anyone: meat, poultry, fish, and eggs skyrocketing. Coffee, also very strong. Housing in many different metrics are also still very strong numbers. Where are the weakest parts of inflation? Gasoline, fuel oil, durables, and airline fares. So the next Fed cut is coming. How do we know this? Well, in yellow, S&P 500, in blue, Fed funds futures. These are the probabilities for the June meeting that the Federal Reserve will not cut interest rates. And what we can see is a pretty strong correlation. When the stock market goes down, so do the Fed funds futures. That leaves a probability of no change, meaning as the stock market goes down, the probability of a Fed cut becomes more and more likely. Now, the Fed futures are not in a panic, and this is important to mention. We'll show you what we mean. In yellow, that's a probability that, again, for the June meeting, the Federal Reserve will not cut rates. In blue, the probability of a quarter point cut. In yellow, half a point cut. Notice what's happened just in the past week or so. We can see here the probability that the Federal Reserve will cut rates by a half a point, that's in red, fell from 28 to 14%. Just yesterday, we were at 28%. Now we're at 14%. During the same period of time, the odds of a quarter point cut, well, they're rising. It's solidifying the opinion that the Fed will cut rates, but only by a quarter. We've mentioned panicking. If we were in a panic, if we get, the Federal Reserve futures, I should say, the Fed futures saw the stock market plummeting and says, "Oh, we really got to, we got to step in," we would see the odds of a half a point cut rise. But that's not the case. It's just firming up a June cut. So the question is, should the Fed cut rates? Well, let's take a look at the non-farm payroll on the left-hand side. That was 151,000 jobs reported. Remember, of that, 140 were private sector, 11,000 jobs were government. Well, that non-farm payroll does not yet at all take into consideration the massive amount of federal layoffs that we're seeing in the news, and we expect to hit the tape in the next non-farm payroll number. Many expect this to be a very poor number. Then, right side, consumer price index, what we're talking about today, a turn in the right direction, 2.8%. So I'll pose a question. Given the weak job growth and possibly a disastrous number next month, plus declining inflation, is this the right move for the Fed to cut rates? Now, what about good news for stocks? How is this good news? Well, the good news is the bonds are ignoring the trend. What does that mean? In yellow, S&P 500. In blue, 10-year U.S. Treasury bond. You can see a pretty strong correlation. Just from last week, we saw the S&P 500 at 5770 dropping down to about 5600. That's a 170-point drop. That's pretty big. Well, during the same period of time, the 10-year U.S. Treasury yield went from 432 to 432. It didn't change, which is a little unusual considering there's usually a very strong trend. Again, yellow line, S&P 500, blue line, 10-year bond. And we can see they're both in a trading range in mid-January, both selling off together in mid-February, but now we see the 10-year US yield pop. Now, why didn't the stock market go up? Well, the S&P 500 is, controlled by, or indicates the prices for 500 different stocks. A Dow Jones Industrial Average is 30. So depending on the weighting, depending on which stocks moved in which direction, the index may not follow. But it is certainly a very encouraging sign, and this just happened, that the S&P 500, we would hope, will find a bottom and begin to find some sort of foundation after sliding so much, in part due to the fact that the 10-year yield looks like it's bucking the trend. The economic calendar has a producer price index. That's for Thursday. This is a very interesting number. If you recall, last month we compared PPI to CPI. Producer price index, those are wholesale prices. Those are very strong. And we saw that there was a lot of inflation at the producer level, and we were concerned that inflation would eventually carry over to the consumer. Well, that's not the case. So will the PPI also be weak tomorrow? Tell us what you think. Do you think it's time for the Fed to cut rates? We're projecting a cut in June. Or do you think they should hold pat? Let us know in the comments. Very interesting to see what you have to say. We hope this has been helpful. We look forward to seeing you back soon.